Alright, but welcome to the second part of the Inception model. I hope you're doing well while watching this video. Today we are going to be taking a look at the PDA array matrix and the role it plays when it comes to the Inception model. So the PDA array matrix is printed as the algorithm delivers. So PDA arrays are very important when it comes to framing a narrative, framing entries and exits, as well as gauging order flows. So PDA arrays are like breadcrumbs the algorithm leaves behind as it delivers. And with the acknowledgement of these PDA arrays, like mentioned, order flow can be gauged, entries and exits can be framed, as well as arriving at a narrative, allowing for one to understand where price action is going and how it intends to get there with the use of sound logic. And footnote on the bottom right, simply just clarifying the abbreviation PDA, which stands for Premium and Discount Array. So taking a look at the PDA array matrix, it's important to take a note of the fact that this is a very strict order in which these PDA arrays are laid out. But starting at the top, and these would be referred to as premium arrays because they're located above an equilibrium. And as we know, anything above an equilibrium we can deem as a premium, and anything below an equilibrium we can deem as discount. So you have your old high or low, rejection block, order block, fair value gap, volume imbalance or liquidity void, breaker block, and then mitigation block. Now, the mitigation block being the last PDA array within the matrix before approaching the equilibrium. And once the equilibrium is crossed, the PDA arrays are now referred to as discount arrays. So you have your old low or high, rejection block, order block, fair value gap, volume imbalance or liquidity void, breaker block, and then your mitigation block. And footnote on the bottom right, exclaiming the fact that there is no such thing as one PDA array being better than another PDA array. The propaganda one may see on social media relaying the fact that X, Y, and Z is the best PDA array or X, Y, and Z is the worst PDA array is false information. Switching the PDA array that you pay attention to is not going to make you a better trader. What makes you a better trader is how you use these PDA arrays during the deliverance of price and how you internalize these PDA arrays during the deliverance of price. Now, if I'm being completely honest, these are not all the PDA arrays that exist within the matrix. We're missing the likes of time-based PDA arrays, which are PDA arrays that can only be perceived through the lens of time, such as your new week opening gaps, new day opening gaps, opening range gaps. And then there's also price-based PDA arrays missing from this list. So that would be the likes of implied fair value gaps, inversion fair value gaps, and event horizons. But it's not a case of I'm gatekeeping all of these other PDA arrays. It's a case of they serve no purpose when it comes to executing the Inception model. This series is dedicated to the Inception model. Now, having the knowledge of all these other PDA arrays, the only purpose that it's going to serve an individual is the ability to gauge order flow on a more advanced and refined level with the aid of their experience. Now, if you're someone with a curious itch to scratch and you're hearing about all these PDA arrays and you want to learn more about the function of each one of them, you're simply just going to have to wait until I release the card counting series, which is a series dedicated on how to perceive price action through an algorithmic lens and how to engage with price action through that algorithmic lens. But away from that tangent and moving on, how are PDA arrays printed? PDA arrays are printed while a range is being established in price. And while this range is being established, not every PDA array within the matrix is going to present itself within that given range. This simply just means that the likes of a volume imbalance, breaker block, mitigation block might not form during the deliverance of a given range. Now, one might pose the question being, what is a range, or how do we define a range? A basic schematic displaying a range. Now, ranges do have their own dedicated part within this series, so I'm not going to dive too deep into ranges, as well as the fact that ranges are a lot more intricate than just a swing high to swing low. But with the observation of this schematic, a range is established with the formation of a swing high and a swing low. And what we look to pay attention to is in between these two swing points, and this is where we can see PDA arrays from the matrix present themselves in price. So just putting the PDRA matrix next to a range, so you'd have your old high, and then your rejection block will be followed after, and then you have your order block, your fair value gap will come in, your volume imbalance or liquidity void, and then you have your breaker block and mitigation block. And then you have the range low where you'd find your old low, which is then followed by your rejection block and then your order block, and so on and so forth. Now, we're simply just going to be taking a brief look at what each one of these PD arrays look like. Most of these are going to be bearish versions, so one's just going to have to use their imagination in order to picture a bullish version. But an old high, this would be your old high. If we're speaking old low, we'd simply just be observing this candle's low. And then taking a look at a bearish rejection block, it would be the closing of this bullish candle, and then it would be the high of this bullish candle, which would be your rejection block. And then you have the order block, which would be these two up close candles. This would be your order block low, order block high. Your fair value gap being a bearish fair value gap, so it would be the second candle within this sequence. This would be the fair value gap high, and that is the fair value gap low. And then you have the volume imbalance or void. So this would be the volume imbalance or void high, and then the volume imbalance or void low. Now, the thing is, this is actually a volume imbalance. The way this becomes a void is if this wick did not exist. So if this candle just opened, did not form a top wick, and just continue delivering down, it would then become a void. And then moving on to the breaker block, so this would be your breaker block high, and then that's your breaker block low, so it would be these two down close candles. The formation of a breaker block would be high. This is a bearish breaker block, so it would be a high, low, and then higher high, and then lower low. That is the formation of your bearish breaker block. And then you have a mitigation block, being these two down close candles. This is the mitigation block high, mitigation block low. Formation of a mitigation block would be a high, low, lower high, and then lower low. Now, if we just pay attention to the bearish breaker and the bearish mitigation block, what we can take a notice of is that the breaker block engages with this high, and we see that the mitigation block fails to follow suit. Now, if we're paying attention to two correlated assets, this is where you're going to spot a crack in correlation. But with the acknowledgement of each individual PD array, the objective of the model should be circled back on, and it is to align entries with higher time frame institutional order flow, capture the smart money reversal of market maker models, and frame higher time frame power of threes. This is the objective of the model, and by doing this objective, it allows us to pinpoint the high of the week, low of the week, high of the day, low of the day, high of the session, as well as low of the session. And in order to do this, PD arrays within the matrix are utilized to execute off of. We're not in the business of simply just executing blindly without a sense of clarity or alignment, talk less sound logic. So with the Inception model, we are not required to pay attention to each and every single one of these PD arrays. There's only two PD arrays within the matrix that we focus on in order to execute the model, which is the order block and the fair value gap. Now, these two PD arrays are what we are going to study in depth for the rest of the video. This being your order block, this being your fair value gap. So we're going to go over the principles of the order block first, and then the principles of the fair value gap next, and then jump into the charts to show some examples. Now, I did just go through the entire list of the PD array matrix. We looked at each and every single one of those PD arrays. It wasn't a waste of time. They will be useful at a later point in time in relation to this series. So an acknowledgement of those PD arrays should be taken into account. So the principles of an order block. The mean threshold of an order block should be respected. And the mean threshold being respected looks like the body's not closing above or below, depending if it's a bearish or bullish order block. So the bodies are not closing above or below the mean threshold of the order block. So series of consecutive up close candles is the bearish order block. Series of consecutive down close candles for the formation of a bearish order block. And then series of consecutive down close candles is the bullish order block. Series of consecutive up close candles for the formation of a bullish order block. And then footnote on the bottom right, simply just stating that an order block can be an individual candle. So it doesn't have to be a series of consecutive up close candles or a series of consecutive down close candles. Likewise, for the formation of it, it can simply just be one candle that confirms and forms the order block. Now, all of this text may seem a little confusing. It's simply just for note-taking purposes, ultimately just having a clear technical definition in writing. So, of course, I have schematics in order to offer a sense of clarity. So bringing attention to the text at the bottom of the screen, series of consecutive up-close candles is the bearish order block. So if we're taking a look at the schematic on the very left, we have a series of up-close candles. This would be what we are deeming the order block. And then a series of consecutive down-close candles for the formation of the bearish order block. So we have these series of down-close candles confirming this bearish order block. When does it confirm it to be a bearish order block? Once we have the closure underneath the open of the sequence of candles. Very important. Body closure underneath the sequence of candles. When it comes to observing price, gauging order flow, we want to be paying attention to the bodies. The bodies are very important to be paying attention to. If price action was to deliver down, form a wick under the opening of the sequence of up close candles, and then we end up closing back inside of this range, the formation of an order block has not been confirmed yet. It is not sufficient enough for us to say we can execute off of it. You want to see that body candle closure under the opening of the consecutive up close candles for a bearish order block. Now, there are two other schematics on the right, which are both order blocks, except the sequence is interrupted. So bringing back attention to the text, series of consecutive up close candles is the bearish order block. So we have series of consecutive up close candles, and then series of consecutive down close candles for the formation of the order block. We don't have a series of consecutive down close candles here. The sequence is ruined with this up close candle. Now, the reason why we are still deeming this a valid formation of an order block is because this candle is an indecisive candle. An indecisive candle is when the wicks are larger than the bodies. So the range of the wick on either side is larger than the range of the body. That's how we identify an indecisive candle. So footnote on the bottom right, simply just stating the fact that indecisive candles within the sequence do not invalidate the formation of an order block. And then with the schematic on the right, bringing attention to the text, series of consecutive up close candles is the bearish order block. So here we don't have a series of up close candles. Once again, the sequence is ruined, but with an indecisive candle, so it doesn't invalidate this as being an order block. And then series of consecutive down close candles for the formation of the bearish order block. And we have the series of down close candles here confirming that order block. So when we are anticipating for a point of inception to present itself in price and everything is in alignment, being time and price, and it's simply just a matter of waiting for the PDA to form in order to execute off of. So in this case, we're waiting for the order block to form. If an indecisive candle forms during the formation of that order block, we're just going to ignore it completely as if it does not exist. And then just taking a look at the bullish order block simply just being the exact opposite of the bearish version. So we have a series of consecutive down close candles, and this is your bullish order block, and then a series of up close candles for the formation of the bullish order block, closing above the series of these down close candles. So moving on away from order blocks and taking a look at the principles of a fair value gap. The consequent encroachment of a fair value gap should be respected. So once again, this is simply just the midpoint of the fair value gap's range. We should not see any body candle closure above the consequent encroachment. The wicks can go above it. They can go way past the fair value gap. Wicks do the damage, bodies tell the story. So it is a 3 candle formation. Candle 2 is the fair value gap. So the low of candle 1 does not overlap with the high of candle 3 for the formation of a bearish fair value gap. And then the high of candle 1 does not overlap with the low of candle 3 for the formation of a bullish fair value gap. Once again, may seem confusing. in plain text, but schematics will clear up that confusion. So paying attention to the schematic on the very left being a bearish fair value gap, 3 candle formation, candle 1, candle 2, and candle 3. So the low of candle 1 does not and should not overlap with the high of candle 3 in order to have the formation of the bearish fair value gap. The range in between the low of candle 1 and the high of candle 3 is your fair value gap, being this range right here. And the same applies for the other two schematics. Now, the only difference with these schematics is candle 1 is an up close candle on this schematic, and candle 3 is an up close candle on this schematic. Now, this doesn't affect the formation of a fair value gap, but with the acknowledgement of this, it allows for one to gauge order flow. Now, it's not to say that these two are not going to work. They're just not as high probability as this one right here. And the same goes for the order blocks as well. This would be the highest probability order block. It's not to say that these are not going to work or that they're ineffective, because if everything is in alignment, the underlying motion is still going to unravel itself out in price. But in relation to gauging order flow, I'm not going to touch on it too heavy, as we haven't really reached the part of the series where we can begin diving into it. But moving on to the bullish fair value gap, same thing applies here again for the bullish fair value gap. So the high of candle 1 does not and should not overlap with the low of candle 3 to have the formation of the bullish fair value gap. The range in between the high of candle 1 and the low of candle 3 is your bullish fair value gap, being this range right here. And then lastly, before moving on to the charts, we're going to first take a look at the inversion fair value gap. With the inversion fair value gap, it requires the formation of a fair value gap, be it bullish or bearish. Now, in this case, we're paying attention to a bullish inversion fair value gap. So it's going to require the formation of a bearish fair value gap first, because in order for the inversion fair value gap to form, we need to see a body closure above the bearish fair value gap. So as we can see here, we have a bearish fair value gap, and then it transitions into an inversion fair value gap once we have a closure above the bearish fair value gap. And once this ends up occurring, the use of the PDA array ends up being flipped. So the use of this bearish fair value gap is flipped. Instead of this bearish fair value gap being utilized as resistance, it is now going to be utilized as support. And if you've been paying attention, you can come to the observation that the formation of the bullish inversion looks awfully similar to the formation of a bullish order block. So if we're looking at the bullish order block right here, very similar. All it would require is this candle here to be a fair value gap. And that is key. If we are combining these two together, that segment of price action becomes very, very powerful as long as time and price are in alignment. So to be quite honest, it's really just the opposite for the bearish gap. So it requires the formation of a bullish fair value gap. The inversion fair value gap is confirmed and formed once we have closure below the bullish fair value gap. And once we have that closure below it, the purpose of the PDA array is flipped. So instead of it serving as support, it's then going to start serving as resistance. We're now just going to be taking a look at some examples of the PDA arrays that we've been paying attention to. So I am simply just going to select a random day, and then we're just going to find some examples. So paying attention to price action right here, so here we have the Inception model. Now, we're not looking at the other correlated assets. So I'm not looking at ES, I'm not looking at YM, but I can tell that this is a point of inception in terms of there is a cracking correlation that forms here. But besides all of that, if we are to actually just layer out the PDA array matrix to see how it unravels itself out in price, what we have here, you would have what would be the old high, and then that is followed with the rejection block, and then after the rejection block, the order block then follows, and then we also have this fair value gap that resides right here. These two down close candles right here would be your breaker block as well. We can see how they are overlapping with your order block. This right here is a very, very strong point of inception. If I'm to go on a little tangent, all of this price action is occurring during our 30-minute window. We haven't even touched on time yet in relation to this series. All of this price action is occurring during our 30-minute window, and we're seeing how we have this fair value gap overlapping with this order block, and then you have your breaker block. Very, very strong price action. What do we take a notice to? We don't even close inside of the fair value gap. When I was speaking about the principles of a fair value gap, I was stating the fact that we don't want to see price action close above the consequent encroachment. But it's even better if we do not close inside of this fair value gap at all. Why? That is an indication of how heavy order flow is going to be, as well as the fact that when we take a look at the formation of this order block, it is a clean sequence of up close candles as well as a clean sequence of down close candles. The formation of the fair value gap is 3 straight down close candles right here as well. This is okay, December 2025. But yes, very clean point of inception. Like if I'm to get even extra carried away right now, anchor a standard deviation right there, just like magic. But let's try and look for another. Okay, I have just spotted point of inception right here. This is during Asia session, and here we have an indecisive candle. So right here is a 3-drive pattern. This is a signature that we're going to take a look at later on in this series, but there's also more than likely cracking correlations that are establishing itself here in price. But observing this point of inception right here, what ends up occurring is we have a order block formation that resides right here. Now, as we know, with the formation of the order block, we're looking for a bearish order block. We're looking for a series of up close candles, series of down close candles. What ends up occurring here is the series of up close candles ends up getting ruined. We end up seeing this candle ruining the sequence, but it's an indecisive candle. How do we know it's an indecisive candle? Simply naked eye, just looking at it, the wicks are way larger than the bodies. But if you really want it to be technical, you can go ahead and grab yourself a measuring tool. But indecisive candle, we're ignoring it. It does not count. We end up seeing how we form the order block. Very, very heavy candle right here. Devil's mark printing on top of the candle. This is also another way in terms of gauging order flow. Devil's mark printing that candle, very heavy deliverance imbalance created right here. Now, we also have to take into account the time of day this is going on. So Asia session is printing. This is why I've stated we have not touched on time yet, but during Asia session, you can expect to see price action like this. It's not a surprise. Now, only sometimes when Asia is permitted, it's going to move in a very nice manner. But let's try and move on and find another point of inception displaying our PD arrays. So this right here is a nice point of inception, but you know, we've already acknowledged it. I'd assume there's a cracking correlation right here. This is your New York lunch high. So cracking correlation presenting itself here would be extremely clean for it. You have a series of up close candles, series of down close candles. In fact, this is actually a good example because we can see how many candles is our order block, and this is normal. It can either be one up close candle or it can be 2, 3, 4, 5, 6. It doesn't matter how many candles. Sequence of up close candles, sequence of down close candles for the formation of a bearish order block. Going to try and find some bullish examples. Right now, so in relation to like what I'm looking for, I'm paying attention to time. Wow, I'm paying attention to time in order to see what time of day, because these things occur during specific times of day. So right here, this looks like it is your 10 a.m. power of 3. Bullish example. So this is nice. This is one candle. So this would be the formation of your bullish order block. So you have one down close candle, series of up close candles closing above it. That is the formation of your bullish order block. Now, if you've been paying attention, what you can take a notice to the fact of all of these order blocks that I've been layering out, they've done something of significance. They've engaged with a pool of liquidity. We can see this one candle displacing down, engaging with a pool of liquidity right here. So we have displacement through a pool of liquidity. This then becomes an inversion fair value gap. So we have your order block, you have this bearish fair value gap becomes an inversion fair value gap. If we were to trade back down into it, we're going to look for it to be utilized as support to continue that buy side delivery motion. This is what makes the order block valid. So that engagement with that sell side, and then we have the formation of this order block with the formation of a bullish fair value gap. Bullish point of inception here. This will be the last one we're going to take a look at. Series of down close candles, series of up close candles. We see the series of down close candles engaging with sell side right here. What we can take a notice to is the mean threshold of this bullish order block is being respected, and that is exactly what we like to see, especially with these conditions. Now, gem right here in terms of when we're looking at this price action, very heavy move down towards sell side, very heavy move. So ultimately this move back up towards buy side is going to be high resistance. Now, in relation to gauging order flow, understanding if you're on the right side of price action, the algorithm is always going to adhere to the rules that it's set to adhere to. Even though all of this price action is very high resistance, how do we read through this price action? Are we respecting the mean threshold of this order block? So yeah, simply just going to end the example part there. I feel like I've dragged down the video quite long, but that is all for the PDA matrix. But before I wrap this up, with the release of this part, I do feel inclined to say that what's been shared so far is only a fraction of the full picture. So to put it into perspective, think of it as having the ingredients to a meal that you're trying to cook, and the meal you're trying to cook is the full model. Right now, you only have been given ingredients with no instructions on how to cook those ingredients. Without the instructions, you won't know what order everything follows. In order for you to cook that meal as it intended to be, you might just fuck around and boil the fucking onions instead of frying them. And once these videos get longer, once we begin taking a look at time, market maker models, all of the sorts, power of threes, that is when we are looking at the instructions as to how to genuinely cook with the ingredients that we have in our hands. So I am constructing this series in a manner I deem fit. However, each part of this series is interconnected, so I'm going to be referring back to older parts of the series during later parts. And of course, I am going to reference when I'm referring back to an old part, but it's important to take an understanding to each part in order to build that bigger picture. Because by understanding that bigger picture, you're going to know when, where, why, and how. You're going to know, for instance, when this type of setup is going to occur, where this setup is going to occur in price, why it is going to work, why it is delivered like this, as well as the fact that you're going to know how it's going to deliver before it even delivers. That is understanding the bigger picture. But yeah, that is all for this video. Thank you for watching, and see you in the next one.